You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit TheOptionsInsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com. Welcome to the Options Playbook, the program where we break down cutting-edge option strategies and explain how you can incorporate them into your own portfolio. Whether you're looking to grow your capital with some offensive maneuvers or protect your investments with defensive plays, you can find them all in the Options Playbook. The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities LLC, member FINRA and SIPC. Now, let's open the playbook and get started.
Welcome to Options Playbook Radio. I'm your host, Brian Overby, Ally Invest Senior Options Analyst and author of The Options Playbook. All right, so let's start by doing a quick review of what we looked at last week. Not too much to talk about. We talked about doing a fig leaf in Disney, and I'm just going to recap where that stock is currently at. So last week we had Disney at 145.52 on the day. That stock had just made a big run up. They announced their Disney Plus, and I guess they had buku subscribers, and the stock took that as good news, and it made a big run up. So we just thought, well, maybe it wouldn't be a bad time to get into the underlying stock. But Disney being a $145 stock, that meant 100 shares of it would be $14,500 some odd dollars to get into the underlying stock. It was a great covered call candidate at that moment in that we had fairly expensive options, had a little bit of volatility in the stock. So we thought about that, but we just, laid down until the urge went away, and we decided to use a stock, an option contract with a high delta as a surrogate for the stock. And so we did the fig leaf. Stock was 145.52. We bought the June 2020 130 call. We sold the 150 call that expires November 29th. Stock was at 145.52. And today we're taping Options Playbook Radio. It's also a Wednesday, like last week when we taped. The markets are closed. It's the 20th. And we see Disney today closed at 146.93, almost 147. It was down a little bit today, down $1.45. But our biggest concern here is that we just need to do something if the stock does get to our short call option, the 150 strike call. And I mentioned last week that there is a section inside the Options Playbook. It's called Managing Your Positions. And if you click on that tab on the website or flip to the appendix in the back of the book, it talks about what to do if you are short a call, in other words, i.e. a covered call position or a fig leaf position, and the underlying stock is approaching your short strike. That's just how to manage the position. You want to make sure that you take care of that position before it gets away from you. And right now, it's safe to say that it has not gotten away. Disney's made a small move up. It's up. At one point in time, it was up a couple of bucks from where we put the trade on. Now, today, it's at, once again, 146.93. It's below 150. We have until the 29th of November before our short call goes away. And if it does, then we'll talk about it again because we'll probably end up selling another call, maybe go out a couple of weeks in time, and a few more strikes higher in Disney. And that's how we'll play with this trade all the way out until June. Okay, so that was a very boring investment trade overall, I would say, but I don't think it's ever boring if the trade goes with you. I'd prefer to be bored in that sense, and that the trade isn't really hurting us at all. It's working with us. So today what we're going to look at is we're coming into December, and a lot of people have at least 1 year memories, right? And last year in December, we had a big downturn in the marketplace. And this year, we've had a big run up going into the December month before the year end. And not necessarily that past performance is a guarantee of what might happen in the future, but I want to look at some ways to protect your stocks without a large cash outlay. Now, a lot of times, this first strategy that we're going to look at today is really catastrophic protection. It's not going to protect you from a small move down, but it would protect you from a big drop like we had last year in December. And probably the stocks that have really been carrying the marketplace this year and for the last couple of years overall are a lot of the technology stocks. So the stock that we're going to look at today is Facebook. Facebook hasn't knocked it out of the park like Apple has recently, but most people that probably have Facebook probably have a fairly low cost basis on it. And right now, as of the 20th, when the market's closed, a Wednesday, we see Facebook last traded at $197.51. It was down $1.81 on the day. So let's say we have 100 shares of Facebook, and we've had this position on for some time. Well, maybe we've got a cost basis down around the 100 level or maybe even the 120 level, but quite a bit below where the underlying stock is at. We're going into the end of the year. If you want some protection to get yourself to the end of the year, one of the things that we might think about doing is actually a ratio spread. And you can do this specifically. I'm picking out a stock that's trading around $200. Obviously, a lot of the FANGs are in that range. We got some that are extremely big, like Amazon and Google, but like Apple right now, the last trade was at $263.19. That was down $3.10 on the day. So when you have more expensive stocks and you think that you have 100 shares of this underlying stock, just buying a put is going to be more expensive. And that's just the general pricing dynamics of options. If you think of options where they first came from, they really were insurance products. And a lot of people think of them as speculation tools, but the background or the reason why options contracts were actually invented was more so to help protect than it was to help speculate. So if you're looking at a put option on an expensive stock, it's going to cost you more to insure a $200 stock against a downside movement than a $10 stock. And just like in the car world, if you're thinking about it, it's going to cost you more to insure your Bentley than it's going to cost you to insure your Chevy Cavalier. That's the same concept. The more pricey the underlying stock, the more pricey the option contracts are. And that's without regard to the actual implied volatility in the underlying. Okay? So if I look at Facebook right now, and I'm going to look at a 30-day option contract. You can choose whichever contract that you'd like as far as how much protection you're looking to get. But the 30-day option contract, the at-the-money implied volatility is trading around 24%. If I were to buy an at-the-money option, which is a good thing with Facebook because it closed right at the money, closed at 197.50, and we have a 197.50 strike put option on the 30-day option contract that expires December 20th. And we see that option contract is trading for $5. Now, that's going to be the most expensive option contract. When you think about it's like buying a zero deductible car insurance policy, right? Those are going to be fairly expensive. So if I think of $5.30 in Facebook, a lot of times people look at that cost and they think to themselves, well, I'll just sell it after it goes down $5, right? I'm going to get out of the position or wherever. But $5 is about almost 3% of the stock price, just under 3%. And that would give you pure protection, though. It would give you unlimited upside, and it would give you a limited and known downside. That's what a protected put is all about. So what about a way that we can address this where we can get the cost down but still give us some protection to the downside? And the way that I look at it, and some people will actually refer to this strategy as a pay later put. And I'll explain that once we get the strategy out, why that name is pertinent. But if you're thinking about this strategy and you think about it as a put for protection, it will make sense why the name of the strategy is a pay later put. So let's get the trade. Let's look at the actual option contracts that we're going to use in that December 20th expiration to give us some catastrophic protection to the downside at a much lower cost than just buying puts outright. Okay, so here's the trade. So once again, don't forget, we already own the stock. We have owned the stock for a while. We probably have a fairly decent cost basis on the stock. The stock has now ran up. It's trading at 197.51, and we come out and want to protect ourselves going into the new year. So we're going to use the December 20th expiration. It is 30 days away. We come out and sell one 195 strike put, and then use the proceeds to buy two 190 strike puts. In this instance, we're selling the more expensive option contract, and we're going to try to pay for two less expensive option contracts. Now, in this instance, the ideal scenario would be that you could do this for a net credit to the account, and if Facebook continued on up, you actually would profit from your protection. Now, that's all up to you, but once again, you got to think about how catastrophic of risk do you want to take. So in this instance, we're taking risk from 197.50 down to 195. That is the difference where the stock is at and the put that we are buying to help us protect ourselves. Now, if the stock continues on down, it goes from 195 down to 190, and that happens close to the expiration. Now, this is very important. It's better if the move happens right away, but if it's close to the expiration, we actually have a put credit spread that's embedded into our position. So that would add another 5 points of risk. So now we're looking at about 7.5 points before our insurance would kick in. And from 190 on down, since we are short one option and long two options, that second option contract would protect our stock from 190 on down. So in this instance, we're going to put this entire position on, right? Remember, we already own the 100 shares, so we're going to sell one 195 strike put, buy two 190 strike puts. We're going to do this for a net debit of 86 cents to the account. Now, that's my risk if the stock continues on up. If it stays where it's at or goes on up, now I'm only going to lose 86 cents or $86 on my 100 shares. So I've just reduced the total percentage cost of the insurance from almost 3% of the stock price all the way down to less than 1%, almost 0.5% of the total stock price. So very, very minimal cost. It doesn't give me great insurance. I mean, I'm taking the first 10% of risk on, but from 190 on down, I have an extra long put in this scenario, and that's going to help me out. All right, so where does the name pay later put come from? And here's where it comes from. So this is the worst case scenario that could happen, is that you put this trade on, the stock goes down below the 195 strike, the put that we sold to help pay for this, and it goes right to 190 and then stops. And it doesn't really benefit us any more on the downside because the stock comes down to 190 and it just kind of sits there, and so the insurance didn't really help us. But we had to pay for that put spread that we sold for the extra put protection, which is a 5 points wide, right? We sold the 195 put, and we bought two of the 190s. Well, that means that there's 5 points of risk from that trade, and this is where the name pay later would come in that if the stock did go down, we're going to have to pay for that protection. And I specifically picked one that was 5 points wide because if you remember, when we started on this call, we talked about buying an at-the-money option contract and that trading for $5, right? So this would also cost you that $5 plus the 86 cents, so $5.86 is your maximum risk on this trade. But it doesn't give you quite as good as protection as buying that at-the-money option contract. Your total risk to the downside here then is going to be $7.50, all the way from $197.50 all the way down to $190. But then you have protection the whole way down, and it didn't cost you much to get into it. So some people will find this interesting to do, especially if you're just a little bit nervous about what happened last year and would like to get you to the new year. Now, it does not cap your upside. So if you think about it, Apple, over the last month in November, had one of its best months of the year was in November. And if you would have put this trade on, it would have cost you very little to protect your Apple position, but it might have kept you in your Apple position. And the stock continues on up. You don't cap your upside, and you have limited and known downside on that position. So any stock that's fairly expensive, I mean, I wouldn't really think, if I'm doing a stock that's trading around $20, $25, I'd probably just buy the put outright if I'm just a little bit nervous about it. It's just these expensive stocks make it really hard to just buy a put for protection because the overall cost of the put is directly related to the actual stock's price. All right, so now, some other things to think about on year-end stuff. I always like to mention this. The simplest, probably the most used option strategy out there is to sell calls on positions that you wouldn't mind getting rid of. So look at stocks that you kind of want to sell, that you either want to take a capital loss or maybe a capital gain getting into the new year in your non-retirement accounts, and just think about selling calls on them. It's a good time of year to do that, and if they go up anymore, go ahead and let them get called away. You get to keep that premium, and you get to either take that capital loss or that capital gain. So I always like to think about selling calls this time of year. And if you want to do even something different, a lot of times I might think about selling a call on a stock I wouldn't mind getting rid of, and then using the proceeds to actually buy a put in something else that I would like to protect. In other words, I'm kind of doing a backwards collar in that I might want to go on out in Home Depot and sell a covered call on Home Depot and use the proceeds to buy some protection in Lowe's. Home Depot's had a good run-up. Lowe's hasn't quite done as well this year as Home Depot has. Maybe this is a good way to do that. Take that capital gain, if you want to put it in this year in Home Depot, and then use that put or use that proceeds to help buy the put to protect the Lowe's position. That's just one example. So I like to get creative at the end of the year. Think about what you want to happen as far as your account is concerned, capital losses, capital gains. A lot of things happen as of January 1, 2020. That's it for this episode of Options Playbook Radio. If you have a topic you'd like us to discuss on the show or a question you'd like us to answer in the program, you can send them directly to me at TheOptionsGuy@invest.ally.com. Thanks for listening. We'll be back at the same time, same place next week. Until then, may all the options you bought finish in the money, and all the ones you sold finish out.
The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities, LLC, member FINRA and SIPC. You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit TheOptionsInsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.